Here's what's happening right now in 2026. The top 10 stocks in the S&P 500 hold 40.7% of the entire index's weight, but those same 10 companies only generate 32% of the index's earnings. Let that sink in. You're holding nearly 41% of the market, concentrated in companies that are only earning a third of what that weight should deliver. You're paying bubble prices for normal growth, and most people have no idea they're holding it. Most people think they're diversified. They bought an S&P 500 index fund, maybe some bonds to balance it out, called it a 60-40 portfolio, and figured they're good, safe, diversified, protected. But in 2026, here's the uncomfortable truth. You're not diversified. You're betting everything on a handful of mega-cap AI and tech stocks, and the rest of the market is essentially flat. The reason your safe 60-40 portfolio is about to blow up isn't what you think. It's not about recession or rate hikes or geopolitics. It's something way more fundamental. The entire premise behind diversification, the math that made it work for decades, has completely broken down. And if you don't understand why, you're sitting on something dangerous. The K-shaped economy in 2026 means that diversification only works if mega caps keep winning, and they won't forever. When this reverses, which it always does, your diversified portfolio isn't going to save you. In the next 15 minutes, I'm showing you exactly why the diversification advice you've been following is killing your wealth and what actually protects you instead. Let me break down what's happening behind the scenes. The 60-40 portfolio was designed in a completely different market. When that strategy was created, the top 10 stocks held about 18% of the index. That was actually diversified. You could own an index fund back then and genuinely get exposure to hundreds of different companies moving in different directions. The math worked. But now the top 10 hold 41%. The foundational math that made 60-40 safe is completely broken. Bonds are supposed to be your hedge. When stocks crash, bonds go up. That's the entire reason the 60-40 split exists. But in 2026, something's shifted. Stock and bond correlations have turned positive. When correlations turn positive, bonds move the same direction as stocks. That means when the market crashes, your hedge crashes with it. Your bond allocation isn't protecting you anymore. It's just another bet on the same thing your stocks are betting on. The valuation gap is massive. The cap-weighted S&P 500, the version most people own, trades at a 30% premium to equal weight. That gap hasn't existed since the dot-com bubble. We're talking about the kind of valuation disconnect that preceded one of the worst drawdowns in modern history. Most passive investors don't even know this gap exists. Here's what keeps this so dangerous. The top 10 companies hold 40.7% of the index, but only generate 32% of the earnings. You're not buying value. You're not buying growth aligned with weight. You're paying bubble prices for normal growth. The gap between what these stocks are worth versus what they actually earn is enormous. The K-shaped economy makes this exponentially worse. Half the market is booming, half is stagnant. Your mega caps are in the boom half. Everything else is struggling with high borrowing costs, wage stagnation, and declining margins. Your diversified index fund is actually concentrated in the boom half. You're getting zero exposure to the half of the market that's about to catch up when rotation happens. Here's a real example that should terrify you. Someone with a diversified 60-40 portfolio in 2025 saw 17.9% returns. Sounds great, right? But that return came almost entirely from 2% of S&P 500 constituents, 2%. Everyone else in the index was basically flat. That's not diversification. That's concentration dressed up to look safe. Here's where it gets really sneaky. Passive flows are creating artificial demand completely divorced from fundamentals or company quality. In 2025, $903 billion flowed into passive funds, while $189 billion left active funds. All that money has to go somewhere. It doesn't pick stocks based on value or potential. It automatically flows into the same mega-cap stocks already dominating the index, because the index automatically weights them the heaviest. This creates a reflexive loop that most people don't understand. More money chases the same 7 to 10 stocks. Their prices go up. They become even bigger in the index because they're weighted by market cap. So the index automatically allocates more to them. More passive money chases them. It's completely self-reinforcing. The bigger they get, the more they attract. The more they attract, the bigger they get. It works fine until it doesn't. And when it breaks catastrophically fast. Active managers can't compete in this environment. 79% underperformed passive over the past 10 years. That number sounds like active managers lack skill. But here's the thing, that's not what happened at all. They underperformed because they were trying to diversify. They made bets on the 90% of the market that's stagnant instead of the 10% that's winning. They picked value stocks and got crushed. Why? Because the market stopped caring about fundamentals. It just chased momentum into 7 stocks. That's not active failure, that's the system failing. The correlation problem nobody talks about is the real smoking gun. The top 10 mega-cap stocks have 45% average correlation with each other. They move together. The rest of the market, the other 490 stocks, only has 30% correlation. Diversification only works when holdings move differently from each other. But you've built a portfolio where your biggest positions all move in lockstep. You think you're diversified, you're actually holding the most correlated portfolio possible. Bond diversification is completely dead. BlackRock's 2026 outlook is crystal clear on this. Stock-bond correlations are turning positive again. That positive correlation means in a 60-40 portfolio, when stocks crash, bonds don't bounce back to protect you. They crash too. Your entire hedge disappears exactly when you need it most. You're leveraged to the downside in both directions. Here's the number that should keep you up at night. If the top 10 megacaps correct just 30%, which is a completely normal, healthy pullback by historical standards, your diversified 60-40 portfolio drops 18 to 20%. That's not diversification. That's concentration disguised as safety. Bonds don't protect you. They just underperform alongside your stocks on the way down. This is what the Mirage looks like. You see diversification on the label. You own 500 companies through an index fund. You see bonds smoothing volatility. But underneath, you're holding concentrated mega-cap bets, bonds that won't hedge you, and a reflexive system rigged to keep pushing more money into the same stocks until the entire loop breaks. And it always breaks. Meanwhile, the people with real money are moving differently. Institutional investors right now are moving into private credit. BlackRock's private credit funds are yielding 10 to 11% annually. Compare that to public high-yield bonds paying 7 to 8%. That's 200 to 300 basis points sitting on the table. That's real money. Retail investors are stuck earning 4.5% on bonds in a 60-40 portfolio, watching institutions pull 10% from private credit. The spread isn't an accident. It's the illiquidity premium they're willing to take in exchange for actual returns that beat inflation and volatility. The K-shaped economy creates 2 completely different playbooks, and smart money knows which side they're on. Mega-cap owners are getting richer because their holdings are skyrocketing. The wealth effect is real. When your stock portfolio is up 20, 30, 40%, you spend more. That spending prop up the economy. But small-cap owners are getting crushed. They're facing 9 to 11% borrowing costs while mega-caps sit on cash earning almost nothing. Small-cap margins are compressed. Revenue is stagnant. Growth is hard. The people with access to private credit aren't pretending both sides exist in the same portfolio. They're choosing. They're tilting away from the stagnant half and toward income and value. That's not diversification, that's clarity. Equal weight strategies historically outperform cap weight during mean reversion periods. When concentration unwinds, and it always does, equal weight beats cap weight by roughly 1.5% annually. Almost nobody owns equal weight strategies because they require active thinking. You can't just buy and forget, but that's exactly why it works. The institutions doing this aren't trying to beat the market through stock picking. They're positioning for the inevitable rotation when mega cap dominance ends and the rest of the market catches up. Small cap earnings growth is actually catching up faster than most people realize. In 2025, the gap between small cap and large cap earnings growth narrowed significantly. When the market rotates, and rotations happen cyclically, small caps could lead by 6 to 10%. A person sitting in a traditional 60-40 portfolio tracking the S&P 500 will miss this entire move. They'll watch from the sidelines while small caps outperform because they're still overweight mega caps that are grinding sideways. Direct lending and private markets aren't accessible to everyone, but they're not off limits anymore like they used to be. You don't need $10 million to get into private credit. Interval funds and evergreen vehicles now offer semi-liquid access with quarterly redemptions. You can actually build a portfolio with meaningful private credit allocation without being locked in for a decade. The terms are getting more reasonable because the asset class is growing so fast that managers are competing for capital. Here's the math that matters. A 60-40 portfolio in 2026 gives you concentrated mega cap risk with bond drag. You're paying for diversification you don't actually have, earning returns that don't compensate you for the risk you're taking, and holding a hedge that won't work when you need it. Equal weight plus private credit gives you actual diversification, holdings that move differently from each other, plus 200 basis points of extra yield on the fixed income side. You're not just safer, you're making more money while taking less correlated risk. That's what institutional money is doing right now. That's what's protecting real wealth in 2026. So here's exactly what to do about this. Stop thinking in terms of asset classes. That's the fundamental mistake. You're not trying to own stocks and bonds. You're trying to own things that move differently from each other. Mega cap tech moves with mega cap tech. Small cap value moves with small cap value. Private credit moves with neither. The goal isn't a fancy allocation split, it's negative correlation. Holdings that protect each other when the market rotates. That's real diversification. Audit your actual concentration right now. Pull up your portfolio and calculate what percentage sits in the top 10 mega cap stocks. Most diversified investors are shocked when they do this math. You'll probably find 30 to 40 or 50% concentrated in stocks that everyone else owns. If it's above 30%, you're not diversified. You're concentrated. That's not judgment, that's math. Rebalance toward equal weight or small cap tilt. This doesn't mean abandoning mega caps completely. It means capping them at 30 to 35% of your equity allocation instead of letting passive flows push them to 50% or higher. Equal weight ETFs make this automatic. You buy once, rebalance automatically to equal weight, which naturally reduces mega cap concentration as they dominate. That move cuts your downside exposure dramatically when rotation happens. Replace bond drag with private credit. If you're earning 4.5% on bonds in a 60-40, you're leaving 200 to 300 basis points on the table. That's real money. A 50-30-20 split, 50% equities, 30% private credit, 20% cash, gives you better returns with lower stock correlation. The private credit diversifies you. It doesn't just smooth volatility, it makes money. Monitor the K-shaped economy. The gap between mega-cap winners and small-cap losers is widening. This is temporary. Markets always normalize. When it reverses, your concentrated portfolio gets crushed. Your rebalanced portfolio is positioned to win. You're not hoping, you're positioned for what always comes. Here's the real action. This week, check your portfolio. If more than 40% of your equity allocation is in the top 10 stocks, you're not diversified. You're riding the mega cap wave and hoping it doesn't break. That's not a strategy. Rebalance, audit, calculate, move the money. It takes an hour. You now understand something most investors will never figure out. Diversification in 2026 doesn't mean owning a passive index fund. It means owning things that move differently from each other. Your homework is simple. Audit your concentration this week. Most people will find their 50+% mega cap without realizing it. In the next video, I'm showing you the exact portfolio structure protecting institutional money and how to build it on a retail budget. Click here to see how the top 1% diversify in 2026.